back with David Verry, who is one of the 800-ish financial mentors all around New Zealand who are here to help people who may get themselves into a bit of trouble when it comes to money or want to learn more about budgeting, but also to advocate for everyday people with different things that are happening in the finance sector. So today we're going to talk a little bit about what the financial mentors are seeing in the KiwiSaver Hardship space and some warnings around using something like that, and then also some changes that we've seen to lending on some of the car yards around the country and what we may need to be mindful of when we are borrowing for a vehicle. So good to have you in as always, mate. I'm looking forward to getting more of your insights.
Yeah, good to be here.
Yeah, well, let's start with the KiwiSaver Hardship withdrawals, because I feel like every month there's now an article about how it's at a record high and it's bigger than last month, and last month was bigger than last month, and it continues to climb. So I guess my first question was, do you think part of it is that more people now are seeing their KiwiSaver as a lever that they could pull and are learning about it, and so therefore thinking maybe I'll use that as a withdrawal? Or is it genuinely we're just that, you know, we're in a tough economy and people are needing it?
Look, it's a mixture of both. And certainly you're correct that people have said, oh gosh, I can see that as a way of getting out. So we will often have people approach us and saying, okay, sit down. Now, what can we do for you today? I want a KiwiSaver Hardship. Oh, okay, well, let's stop there.
Yeah.
All right. Before we jump to what we might call a solution, let's kind of work out what the problem is first. So let's go through literally. Let's start from scratch. Let's start by let's understand all your debts. Let's understand your budget. Let's work out where we sit. Do we have a budget which is in surplus? Likely not. Do we have a budget in deficit? Yes. What are your loan situations? I would say to people, the KiwiSaver Hardship is your second to last option that we will ever look at. And the last option is insolvency, and hopefully we're not here to talk about that.
Yes.
So, but also we're not here to just default to KiwiSaver Hardship, because you're going to need that. You're going to need KiwiSaver when you retire. So let's not go into there, because you try and live on a pension.
Yeah.
When you're finished, it's not enough to live on. So let's work out what other methods we might have to be able to assist you in your situation. Okay, we might have a budget deficit, spending more than we're earning. We might have loans that typically are in arrears. Okay, but first of all, let's look at the levers that we have. Can we talk to? So if you've got a series of lenders, and there'll be could be 3, 4, 5, 6 different creditors stroke lenders there. Can we work things out with those creditors so that we can get your budget back balancing, so that we don't have to go into KiwiSaver? If you're in genuine hardship, then all lenders have to have hardship protocols. In other words, look, I've lost my job, I've got sick, those sorts of things. Every registered lender has to have a hardship protocol to say, yes, I'm in genuine hardship. We are in need of a restructure of your facilities. It might be suspension of repayments. It may be reducing the number of, or the amount of each repayment, but extending the term of the loan. There could be any number of things that we can do to work with lenders to reduce the strain on the finances. And they're all directed to do that. And most lenders are very happy to work. They understand that people fall into difficulties and they do want to work with them. So we'll work through things like that before we jump into, KiwiSaver Hardship withdrawals.
What happens? So does some people hear that and go, oh, I wanted my money, that's my money, I don't like your answer, that sounds too hard, and do they kind of go, I'm going to go ask someone else?
Well, they can, but at the end of the day, they'll possibly be refused by their KiwiSaver provider in terms of being able to make a withdrawal. The rules around KiwiSaver are quite strict. They have allowed it for, obviously you can get it here for your first home, and you can get it for hardship. But again, this is not the hardship. You have to work through the things. It has to be a genuine hardship. And they'll be wanting to see, and typically they will have directed someone to have gone and seen a financial mentor, so that the financial mentor has done the work. They'll be still checking the work that's done, to make sure that, have we got genuine hardship here? Is it someone that's just, we'll call it, might be living too lavish a lifestyle? That I have to say it's very rare that is the case. Have we exhausted all other avenues? And in fact, if you read the KiwiSaver applications, it virtually says, have you exhausted all other avenues? Have you been to work and income and asked, and can I get something from you? And this might be somebody who's not a beneficiary.
Yeah.
You say, well, I'm over the income threshold. You say, yeah, okay, but you've got to produce a letter from work and income to say that you're not eligible for any form of assistance from them. You probably even have to get letters from or we've tried to do the work through with the creditors to try and see if we can get some assistance via hardship. That may or may not be available, but you've actually got to have exhausted all other avenues before you are then eligible for hardship withdrawal.
So the ones that you've seen, what's typical of the profile or the situation that's happened for these people to need to access it?
Look, cost of living's has been a big one where there haven't been any increases in the wages and salaries. The costs have gone up, and again, probably also a mix of having taken on a bit too much debt as well. So the debt repayment obligations are pretty onerous.
Yeah.
So it's often a combination of things, and I've mentioned before. People with mortgages now coming to because of the fact is that the repayments on the mortgages have gone up considerably. So they've fallen into a deficit. Now, when it comes to a mortgage, the bank should be working pretty closely with people with mortgages, and it's. I'd almost be saying it's illegal for a bank to sort of say, right, you nudge, wink, wink, you'd better go off and get a KiwiSaver hardship. No, you've got to work through the things through with your client first before KiwiSaver hardship becomes a thing. But we do end up with people that have got arrears, and of course, when you're in arrears and they're looking to sell your house or sell your car, that's when people will typically be, and it's often a combination of arrears, and then we've done a budget. We're saying, and we actually do have a genuine weekly deficit in your budget. So we will try and, when I say avoid, we're saying we'll look at all other avenues first before we say, yep, you're definitely a KiwiSaver hardship candidate, and yes, and let's try and work things through with that.
Because as you often talk about, it's only a Band-Aid, as you would term it, right?
Yeah, absolutely. Because if you've got a budget that is in deficit, no amount of time you can go back to KiwiSaver every 13 weeks to get cover 13 weeks of deficits, but eventually that money runs out. So something has to change. I use the word that it's typically a gaping wound when you've got that budget deficit. But again, you can't keep going back because eventually you do run out. And I've got clients that have run out. I've little personal haters. I've a number of people that have had money out for paying lawyers for family court proceedings, and literally they've used their entire KiwiSaver proceeds to get themselves through the family court where there's been a separation and that sort of thing. So it's pretty distressing to sort of see that this money is gone, which they are going to need into the future.
Yeah. And they'll be paying legal fees, I'd imagine, with that.
Well, it gets to the point where some solicitors won't work with them unless they've actually got right up to date on their legal fees, or some of them are even asking for retainers in advance. So I've got a bit of a pet hate of the family court. I just think it's a rort for lawyers. Yeah. I mean, I'm sorry. The two winners are the lawyers on either side, and the losers are the respective people in the court. Yeah, that's a bit of a sideline, but I've seen money going out for that as well.
Yeah. Hey, so the 13 weeks, so is the hardship amount basically modelled off of what your deficit would be multiplied over the 13 weeks?
By 13 weeks, yeah.
To give you sort of 13 weeks to try and get it sorted.
Correct. And plus on top of that, if you've got arrears, so the things that we would typically go for is saying, right, you're in arrears on your debts or the people that you owe money to. Can we bring money out for that? And can we do the 13 weeks? And again, you can, next quarter comes along, you can apply again. So it's usually done in 13-week chunks. Yeah.
And were you saying, I think you mentioned to me that sometimes people get the money and then that's the last you see of them, must be sad and frustrating for you.
Well, that's the frustrating part. You have worked with them and you've genuinely tried to assist, and then yes, they've got the money and it's gone, and who knows, in 13 weeks they might front up to another budget service and be trying to do something there. But when the money's not going to what we've worked out with them, that can be quite disappointing. Yeah. And where it's been used to cover some things, and that happens. I mean, it's a human nature thing. Gosh, we got this money in, and we had a bit of a party, or it does happen because we're getting through that period, and that's the biggest thing is we haven't, as I say, we've got this is the Band-Aid. So yes, you've got your money to get you through that 13 weeks. Over the next 13 weeks, we've got to try and find other ways of increasing income, decreasing expenses, so that when that money runs out and you've genuinely used it, it's gone into your bank account, and yes, each week it's covered the deficit. Yep, and we've kind of then run out in week 13. But in that period of time, we're hoping, and what we're trying to work towards is, have we got any way of getting any extra income, and particularly have we got ways of reducing expenses? Have we got a way? Can we go back to the creditors and be trying to restructure some of your finances with some of your loans to say, can we extend the term out for a period of time, which will obviously then reduce the outgoings through that period and give you a bit more leeway. So you're hoping that you're getting time to actually maybe get some things in place.
I think it's important for all of us to learn this stuff, because it's not like KiwiSaver hardship withdrawals are going to go away. So at some stage we might know friends or family that are going to look to this as the solution, but they're not really understand that it's designed to give you a little bit of time to get your budget back in order. And it's no different to us lending money to our friends or family, but they can't then tell us how that would be paid back or what they're going to do with that money to sort the underlying issues, right?
That's right. Yeah, you can't. As I say, a lot of people do end up with friends and family whom they've borrowed from, and that can also run into some big problems when you do that, because you then end up with the friends and family are then, you sort of let them down as well.
Yeah. And so then you could have a massive argument or falling out, or even just the emotional burden yourself of, okay, how am I going to refund this, right?
Yeah. Absolutely.
Getting in the KiwiSaver fund that suits you and your situation is key to making sure you're maximizing your investment. Generate are an award-winning KiwiSaver provider with a track record of long-term performance, and they can help you do exactly this. Their advisors can meet with you to talk about all your options when it comes to KiwiSaver to help you decide what's best for you. Too many people never get KiwiSaver advice, but not you. Go to generatekiwisaver.co.nz/change to book a no-obligation chat with a Generate advisor. A copy of the product disclosure statement is available at generatekiwisaver.co.nz. The issuer of the scheme is Generate Investment Management Limited, and of course, past performance does not guarantee future returns. Okay, anything else on KiwiSaver hardship that we should be aware of?
No, other than, just encourage everybody to be in KiwiSaver.
Yeah.
Just make sure you're in KiwiSaver.
I suppose as well, if people are at a point where they might be facing a bit of hardship in terms of their debt, so just to reinforce, you're suggesting work directly with the lender to start with first, rather than just going, okay, the silver bullet might be to try and get some of my KiwiSaver out, because it might not work like that. But all of the banks, so with mortgages and any form of debt, they have a responsibility to work with you to try and find you a solution.
That's correct. So it typically would be a situation, have you talked to your lenders about trying to work through your problem?
Yeah.
So that is a requirement.
Yeah.
Of most applications.
When we first caught up, you were kind of telling us something was going on with some of the car lenders. So what happened in that space, and what have we seen since we caught up?
Okay, well, at the time, and there's a name I couldn't mention, but I'll mention it now, was a company called Go Car Finance, which was causing problems for many of our clients. And Go Car Finance has now ceased new lending in New Zealand. and is also now being prosecuted by the Commerce Commission for unaffordable lending. So at the time that we spoke, I think between financial mentors around the country, we had built up a dossier of about 60 cases of unaffordable lending having been undertaken by Go Car Finance. And when I say it was by Go Car Finance, this would be people, typically low-income people, who would go into a car yard in the likes of South Auckland and be sold a vehicle that they could never possibly afford to be paying for. They'd be lied to by the car yard personnel who were agents for the company. They would have junk insurance put onto it for all sorts of bits and pieces that they would never ever probably going to use. So that insurance all prepaid up front. So people would be paying over the odds for a vehicle. You go into a car yard and so it's got $10,000 on the on the window there. You could probably get it for $8,000 or something. And in fact, if you went on to Trade Me, you could probably get it for $6,000. But no, it's an overpriced vehicle. You're convinced to take finance on it. It's something that drags you down. It's actually unaffordable. You then start getting into arrears on it. They put immobilizers in the car as part of it. You actually pay for the installation and the rental of an immobilizer that stops your vehicle if you don't make the payments for it, and you're paying for it. Yeah. It's all part of the finance package. So we put in a dossier to the Commerce Commission, and it took 2 years, but they did an investigation, and finally earlier this year said yes, we are going to come forward with a prosecution of Go Car for unaffordable lending practices. Their parent company, which is a listed Australian company, decided to pull the pin on new lending for Go Car in New Zealand. So they are now winding the next 2 to 3 years. All they'll be doing is winding down their book. People still owe the money, by the way. People say, oh, gosh, if they stop doing business, well, no, they stopped doing new business, but they're still here collecting, on the old things. Now, a lot of financial mentors are still in discussions with the likes of Go Car about, well, this loan was unaffordable at the time. So again, we're advocating to, get things changed from some of those loans. So that for us was our number one for financial mentors around the country. Go Car was the number one lender that was causing us the most issues. And so great success for them to cease lending. It was just a major, we call it a battle in the war, yeah. but just one battle in an ongoing war to try and bring lenders that are making unaffordable loans available to bringing them back and trying to bring them into line. There's others out there in the middle of the year. Aotea Finance, which has always been an issue for many financial mentors, they've been issued a warning letter by the Commerce Commission, again on the basis of a dossier that was put together by numbers of financial mentors. Now, warning letter, I sort of said many tongue-in-cheek, it's slap over the wrist with a wet bus ticket, but the Commerce Commission is very adamant, and I agree with them. Look, you've had the warning letter, which means you're in our sights, yeah. And you continue. If you don't pick up your practices, then we could potentially, if they don't follow the rules, then they could be facing a prosecution in the future. So we've seen some changes. I guess one of the big things that's going to happen is that basically the Credit Contracts and Consumer Finance Act, the Commerce Commission was the one that had the oversight of that. That's going to be changing. That's going to be changing to the Financial Markets Authority. So that's an interesting one for us because, to me, Financial Markets Authority tends to be at the big end of town. The banks and insurance companies. And again, a little bit tongue in cheek, I say, gosh, is the Financial Markets Authority going to be worried about, little finance companies providing unaffordable loans when we've got banks and insurance companies that we've the penalties that are there. And the other thing I've always sort of said about the Financial Markets Authority, I said every time not every time, but in the paper when they come out with something saying it's self-reported. The banks and the insurance companies self-report their mistakes. Yeah, and because they know that, oh God, if we've found it, yeah, we don't. We're going to fess up, yeah. And we get the pen, and we'll take could be several $1 million fines and things. But we know that, God, but if FMA finds out that we discovered it, didn't report it, man, the fines will be exponentially greater. So the jury's out on when the oversight for the CCCFA moves to the Financial Markets Authority, whether it's going to be, something that's going to be a focus for them. Again, the jury's out on that.
And what about everyday people who are going to finance a vehicle? Are there specific things that you're educating people to keep an eye out for?
I guess be saying try not to use finance for it, but that would be the first thing. But I guess the one big thing is work within your budget. If you are going to have to get finance for something, work within your budget. The unfortunate part about it is that some, I'm not all car yards, but a lot of these second-hand car yards, when they're dealing, and they're the ones that are actually the agents for the finance companies, they just lie. So, for instance, they might be, in fact, they will actually write the applications for the people, and they'll have a family sitting in the car yard waiting to get their vehicle, and there'll be, husband, wife, and 3 children or 4 children, and in the application, any dependents? No.
Oh wow.
So I have an ounce of, a very small ounce of sympathy sometimes for the financiers, because sometimes the car yards, who are their agents, are providing incorrect information through to them when they're trying to make those decisions. So I guess the first thing is, if you are contemplating getting finance on it, maybe talk to somebody first. Talk to a financial mentor and saying, am I going to be able to afford this? You've also got to watch out the amount of junk insurance that they'll try to sell you. And there's been some very, very good papers. Christians Against Poverty and the Commerce Commission have both put out very, very good papers on essentially junk vehicle insurance. And if you go to either the CAP website or the Commerce Commission website and look at the junk insurance products that people are sold into. When I say they're sold into them, they're typically things that are, you might get a certain insurance for 3 years because that's the term of the loan, but you pay for it. You pay for the premiums up front. In fact, they finance the premiums. So, classic case I had was a gentleman, $30,000 car that was there. Well, actually, when we went on to Trade Me, he could have got it for 17. Right, but a $30,000 car, he had $6,000 of add-on insurances. So over the course of the 3 years, he'd be paying back, was going to be $54,000 were going to be essentially his finance costs over 3 years. Now, on a vehicle which was actually only really worth $17,000. So basically over 3 years, paying back triple the value of the vehicle. So it's getting into overpriced vehicles, or to the extent that the car yard was, look, you can afford. In fact, I've come in for a vehicle which is worth 15, but actually you can afford a $30,000 vehicle, and the repayments are exactly the same. Well, yes, they are. It's just that the term of it's gone from 3 years to 6 years. It's that sort of thing where people, yes, you can afford it. You've got the weekly everything to do it, but they're not providing all the information that's there. So, we'll spend time trying to unwind those. When we're advocating, we may be trying to unwind those deals where it's clear that the insufficient analysis was done by the lender. And I suppose in our go-car cases, that was exactly what we would be doing. We'd be saying, here's our budget. You show us what your affordability assessment was. And then this was wrong. That was wrong. This lending should never have taken place.
Gotcha.
And some people will end up with again, if you miss out, cars repossessed. Well, typically car repossessed, they'll sell it. It's not going to clear the debt.
Yeah.
So you have no car, but you've still got a debt when you're finished, and particularly where that vehicle's has been repossessed. Those are the things we call it, the debt overhang. And it's a real problem with a lot of asset financing, is that if you fail to make the payments, it's sold and it's gone, because it's really only in probably the last 6 months of any of those deals that the actual vehicle is actually worth more than the money that you actually owe on it. A lot of deals, it's the first 3 year deal, the first 30 months. Your debt's what if you sold the vehicle, and even if it was a new vehicle, as soon as you take it off the lot, it's used.
Yeah,
so it's gone down in value. So you're probably for, I don't know, probably 90% of your loan time, your debt exceeds the value of your vehicle.
Yeah.
So it's a real trap.
And then, of course, you've got the likes of insurance and servicing, and you're not thinking about that when you're taking out that loan on the car lot, are you?
Well, that's right. And of course, the insurance and reg on warrant are requirements under the finance contract as well. So that's the other thing, which is why they'll try and sell you into, we'll sell you an insurance product up front. Yeah. But you'll be paying you'll be paying 3 years up front. Well, it'll be financed for 3 years.
Ouch.
That's the thing. I'm actually paying interest on I'm borrowing money to pay my insurance, and I'm paying interest on it, which could be 19, 20%,
Yeah.
Even on a secured loan, it could still be pretty high.
I think it's a good finance lesson in general, right? Where sometimes we can qualify for a level of debt or finance, but doesn't mean that we should take it out. And I think I've had a number of stories recently from people saying that they could get access to XYZ amount of debt to buy a property via a mortgage, but they've chosen not to go, right to that upper limit because they knew how much it would really stress them once they started adding on all the other costs, or knowing that they want to have children or things like that. So I think sometimes we can get a little bit caught out by what we can borrow, and don't really think about, okay, what does this look like over those 3 years, and actually, take yourself through what other costs you would have as part of it.
Well, the other side of that is in the last 3 to 4 years when we went through that COVID period, and of course we geared up on the housing, and of course we've now seen a 20 to 25% drop in the value of many homes.
Yeah.
So people are probably sitting there and going, now I ended up with I might have done with my 20% deposit, and I used my KiwiSaver. I used my first home, so I got all my KiwiSaver money out, or all of it apart from the government stuff. I've used that. I was able to gear up, 80%. Well, actually, my house is now worth. I might just clear the mortgage, but my KiwiSaver money's gone. If I was forced to sell,
yeah,
my KiwiSaver money's gone. And that's the other thing, we're also in this point now where people have been using, KiwiSaver for first homes, but there will come a point at which that generation that's had that will be now getting to the point of retirement and thinking, oh gosh, that initial money I put in, great, used it for the first home, but then I had to start my KiwiSaver afresh again, so your term of getting your compound returns on your KiwiSaver, well, there could be 20, 30, 40, 50,000 that you started with. Well, that's gone. So you've had to start again, right from scratch. So the money then available from KiwiSaver when you get there, that's when the choices of, now somebody would then say, well, okay, when you get to 65 and you've stopped working, or whenever you stop working, I guess you'd then make a choice. Look, if I haven't got a substantial amount in my KiwiSaver or whatever managed funds I've got, okay, well then I downsize my house, for instance, because I don't need it that way. So there at least people possibly have those options, but it's just to understand that when that KiwiSaver, when you've used it up for something, and that's where we've seen recently people with the mortgages, and when they're struggling, you're saying, well, yeah, is selling an option? You go, well, yeah, but you're going to lose a lot of your equity. Your equity is gone, or a large portion of it.
On the downsizing, I've read recently that one of the issues with that people don't think about is that by the time they get to downsizing, they don't want to downsize into the same market and go, right, we'll go from a 3 to a 1 bedroom. They go, we might get a 1 bedroom apartment, but now 1 bedroom apartment is, and they want it to be nicer, etc., or newer. So sometimes they can downsize, but basically it doesn't, free up any cash for them.
That's right.
Because we're going to then want to change the lifestyle that we live as well. So I think it's just again, for all of us to be mindful of when we think, that's my plan, is I'll go all in on my property and then I'll downsize in the future. Okay, have a really good plan about what that actually looks like, because as humans, we don't often like to take steps backwards.
Yeah, and the other thing, of course, is when you've got children, and of course the old thing, the bank of mum and dad.
Yeah,
and you get people actually getting to the point where they'll be thinking, we're going to downsize, but actually, but now our children would like, and part of it they may actually be part of the plan, which is actually we will get to that point, and to the extent our children don't have their own homes, we might be prepared to partially, it's downsizing, but actually we're also releasing some of our equity giving an early, we call it, inheritance
Yeah.
there, so that we can help them get a foot on the ladder. In fact, I think I recall it was something like the fifth largest lender, for homes in New Zealand was mum and dad.
Yeah.
I forget which article it was recently. And again, we're saying, well, hold it, does that mean they're bigger than Kiwi? I think I could be wrong, and it was whether you call it the mum and dads were actually lending more than Kiwi Bank was on more, to assist.
Yeah.
If you looked at it and said it was a pure loan.
It's very material.
It's
anyway,
huge, very material.
Yeah. Well, mate, thank you for coming in. As always, it's good to get some insight as to what the financial mentors around the country are doing, and a reminder for people that you guys exist as well. Should people need help, they can ring 0800 MoneyTalks or look up the Citizens Advice Bureau, for instance, to find where they could speak to a local budgeting service. But also to get some specific insight as to what's happening on some of those car dealerships and the advocacy work that you're all doing nationwide to protect people, but then also to get us thinking about whether we might even consider using KiwiSaver Hardship as a lever, but the risks of doing that too, and actually some insights as to those people who may have used it. So thanks as always, mate. I'm sure we'll tune in again in the future.
Look forward to it.